Good day, fellow investors. My name is Sven Karlin, and today I discuss how put options can help your portfolio. A put option gives the holder the right to sell a stock at a certain strike price for a defined period of time. Or a put option gives the seller the obligation to buy the stock at a certain strike price for a determined period of time. Now, buying a put option makes sense when you think that the stock price will collapse or when you need protection. For example, there are some earnings coming up or a legal dispute will be solved and you want to limit the downside but leave the upside open. You can buy a put option and it protects the downside because you can always sell the stock at the strike price, if the stock price is lower, of course, while the upside remains open from the position you hold. For example, investors that bought put options to protect themselves from a possible negative AMD earnings release at the end of April 2017 did really well, as the put option jumped from 10 cents to above $1 in just a few days. Therefore, an investor that owned AMD stock and bought put options was protected on the downside. If you know that the stock price will collapse, or you think there is a high probability that the stock price will collapse, it's much better to buy put options than to short the stock, because when you buy a put option, all you can lose is what you invested, while by shorting the stock, your risk is unlimited. The part-time investor can be very interested in selling put options on stocks he intends to buy anyway, but at a cheaper price. For example, if you would be happy to buy Apple stock at 140, but you find the current price of 155 too high, you can sell a put option for $3.42 and promise the buyer of the option that you will buy Apple's stock at 140 if the stock price drops. This gives the buyer of the put option protection in case of a stock price drop, and yourself a nice $3.42 premium on the sold put. If Apple's stock price drops to 140, you're practically buying the stock at 140 minus 3.42, thus at a discount. If Apple's price doesn't drop to 140, you received the premium for committing your capital for 5 months. This implies a yearly yield of 5.4%, which is not bad in the current market. Other companies offer much better yields. So before wanting to buy a certain stock, you might want to check what's the yield on selling put options at the price level you would buy that stock anyway. Selling puts is a good way to increase your income, as you keep getting in the premiums on the cash that you committed. However, it's very tempting to sell more puts than the actual cash you have. In case of a bear market where all stocks drop, you would have to do a lot of buying, and you better have the capital committed to buy all those stocks. This is a risk that's inherent to selling put options. So be careful, be covered, and see what's your risk appetite. To conclude, options are very attractive. They really can allow you to buy at lower prices, allow you to buy at discount, but don't get too greedy, as you can get wiped out if the market turns against you. If you have any questions, please leave a comment below. If you want to learn more about selling call options, especially covered calls, check my video on call options. Have a great day and happy investing!